Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney, and finally back, John Tucker. This is Bloomberg Intelligence Radio. We're broadcasting to you live from the Interactive Broker Studio right here in Midtown Manhattan. But maybe one day we should actually broadcast from Industry City in Brooklyn. Paul's never been there.
I don't do Brooklyn.
He doesn't do.
Yeah,
he's going to do Brooklyn. So I live in Park Slope. Industry City is a go-to place. It's good for adults. It's good for kids. They have games. They have free things on the weekends. They got salsa classes. They got concerts.
Wow.
They have ice skating in the winter. They have a lot of stuff. It is a very popular place to go when you have kids. So joining us now is Jim Somoza. He's managing director of Industry City, and he joined us there right now. Hey, Jim.
Hello, everybody.
Are you surprised at just how successful Industry City has become?
I'm not surprised. I think that, we have a lot of history doing adaptive reuse projects like this, like Industry City, like Chelsea Market, which at one time, just like this project, was a number of older buildings that were past their prime, but people really like classic old buildings that you take and redevelop into offices and retail and things that are fun. So we've seen this before, and we've done it at other locations. So look, I'm surprised we took on something as large, if you really want to know, that's 6 million square feet, but we've been able to do it. So from a success standpoint, I'm not surprised.
Jim, talk to us about how you're thinking about real estate, mixed-use real estate, office real estate, in the context of what appears to be a post-pandemic, different way people work and live and go to the office and all that kind of stuff. Sure.
We've been at this since doing exactly what we do, which is adaptive reuse and activation and fun place, creating a fun place to work for a long time. We didn't know a pandemic was coming. It so happens that it came, and what we do is more attractive to people. So what we do here is create a place that people like to come and work. And so we've actually been at 80% of the employees that work at IC have been back in the office regularly for several years now. And so that's kind of what we do, is create fun places to work that are not commodity real estate. I worked in many glass and steel office buildings in my career, and these are just more fun places to work. And people like coming to work when they come to places like this.
So how do you know when a project's going to work, right? Like you mentioned Chelsea Market and then Industry City. Like, what's the secret sauce?
I will tell you. The secret sauce is, so what you first do is you start with the ground floor and the placemaking. And for us, when you do something like this, when you have a project, you need retail, you need food and beverage, you need shopping, you need things like that. But how do you do that without any foot traffic? Nobody wants to come and do retail with you when you do that. So what we did at Chelsea Market, and the same thing here, is we went to wholesalers and commissaries and bakeries and things like that. People that really were interested in the production space more than retail, but they had to do retail with us. That was part of the deal, and we gave them a favorable rate in the beginning to do that. But they needed ground floor space. They needed space that had plenty of loading. Getting priced out of New York City was something that they didn't want. They wanted to be near their customers. So we would go to those, and you go back to Chelsea Market. Lobster Place was a classic example, wholesale fish, seafood place. For us, it was others, bakeries such as Colson's and Lilac Chocolates and things like that. Companies that really were interested in production space, but we wanted them to do retail. So that way, they're two businesses. You don't have to worry about the foot traffic in the beginning while you're getting this going, but what you do is you start to get retail and amenity type tenants on the ground floor and placemaking, and that's how you start to lease the upper floors. Once you start to do that, then you have tenants in the building that are just happen to be right next door to those retailers, and then the retail takes off. And if you're to answer your specific question, how do you know? You know when those folks, who, by the way, didn't really want to do retail with you in the beginning because you didn't have foot traffic, you know when those folks come to you and say, "How can you do more marketing for me? And can you get me more foot traffic? This is fantastic," because they're doing retail margins instead of wholesale margins in their space. As soon as that happens, that's when you know you got something.
So, Jim, how about on like the corporate tenant side? What type of companies want to be in a space like yours?
So we tend to have more creative type companies, lots of designers, architects, marketing firms, things like that. That's kind of very consistent with the Brooklyn market. And Paul, we're going to have to get you out here. So because I grew up in Manhattan, and I now live in Brooklyn. And if you told me back when I was in high school I'd be living in Brooklyn, I would
you see me, okay.
Okay, but so anyway, but we have a lot of that. We are starting to see some more traditional type of companies like finance firms and law firms and things like that, which we did not see in the beginning. But we have a lot of that. We have a lot of industrial. We're 6 million square feet, first of all, so that's a lot of space to fill up with with just one or two types of industries. So we have a lot of distribution and warehouse still, But our office itself focuses more on creative companies. And then we have people like the Brooklyn Nets, so the Brooklyn Nets, their headquarters and player personnel and back office are all here. So it's really, it's a much wider range of types of companies than you would normally see in a project, partially because we are 6 million square feet and 16 buildings. So we have the ability to do things differently building by building that you may not be able to do if you were one or two buildings.
Okay, so what are you going to do next? Like, what's on the Jim's list of things to do?
We are looking at a lot more retail. One of the things that we've been very successful with is our home furnishings. So we've got ABC Carpet and Design Within Reach and Restoration Hardware and places like that. And we have City Foundry, our antique place. So we've really done and West Elm, we've done very well, and Kohler. See, I'm going to keep remembering as we keep going along. But we've done very well with the home furnishings and home goods sector. So we've become known as the place where if you want to come and shop for furniture and things like that in Brooklyn, this is where you come, because you can go to 6 different places. So we are continuing with that. That's very interesting to us. We are very design centric type of property. If you walk around, you'll notice that we do specific design elements that you may not see elsewhere. So that's kind of who we are, and it kind of makes us happy, and we enjoy doing that. That's what gets us, sort of out of bed in the morning. So we're going to continue to do that. We're going to continue to do more retail, food and beverage. We are continuing to grow Japan Village, which is one of the things that we are known for, which is a large Japanese eating, drinking, but now hard goods and cultural center. We started with them at 20,000 square feet. We've now gone to 60,000 square feet. We've got karaoke and Japanese barbecue and Japanese cooking school and Japanese bakery coming. So we're going to continue to do that. We continue to use our courtyards, which is one of our best assets, and that is just large outdoor space that kind of function like city parks, but they are not city parks. We own and operate them, so we do a lot of concerts and things like that. So I think that nothing really that different than what we've been doing from an activation standpoint. We are also very much getting into renewable energy. We have Equinor as a major tenant in a large piece of property just adjacent to us, which is the staging area for a large wind farm that's going on in the south coast of Long Island. So that has really sort of charged us up and made us attractive to other renewable energy companies and industries. And we're very interested in doing that. as well as biotech. Biotech is something that we are very interested in. I think, and we're hearing this from a lot of people, some folks that when they get out of school, they're not that interested in working in an office park in the middle of New Jersey. Nothing wrong with New Jersey. I go there a lot.
Good disclaimer, Jim. We appreciate that.
Good disclaimer, right? I actually have a house there on the Jersey Shore, just to be clear. So, but what we're hearing a lot of, and we knew this. This is how we started doing this years even before the pandemic. Is people want to work in places where they enjoy and they have fun and they meet people and there's a social life to it as well. And it turns out highly educated people coming out of school that are going into biotech want the same thing. And so we are looking into a lot of industries like that, which frankly was not originally something that we really thought about that much when we first started it, but that's how projects like this evolve.
All right. Jim, great stuff, really interesting. I'm going to have to head over there soon.
You're never going to come.
Well, my daughter lives in Brooklyn, so okay. I've been there, but it's just
begrudgingly.
Coming in the 80s, nobody went to
Very
Brooklyn.
different story.
Just saying.
But the best part for those of you who like to buy things in the Design Within Reach, the super expensive mid-century modern furniture, has an outlet store there. And if you go on Friday, Saturday, there's like an extra 20% discount. Like you can get an Eames chair for like $6,000, $5,000.
For a chair?
A chair?
Eames chair. Eames chair. What's an Eames chair?
Yeah.
What? Look what I'm dealing with, you guys.
I
Those
get a
chairs are like
beanbag chair. I'll bring in and give it to
$12,000. Like
Is that right?
They're really, really comfortable. Anyway, it's super fun. You get to go. It's like a scavenger hunt. Like ABC carpet.
How do I spell it?
I'm like basically shilling for Industry City. Eames, EAMES, chair, CHAIR.
Got it.
Those chairs. He doesn't know what an
okay.
Eames chair is. Is this a Jersey thing? I don't
Yeah,
understand.
I don't know.
Okay. Anyway.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, I've got interest rates coming down. I don't know if it's 25 or 50 basis points this week, but I know they're going down. I got an earnings backdrop that seems pretty good to me. We had a good quarterly earnings. Gina Martin-Adams from Bloomberg Intelligence tells me that. So isn't that constructive for stocks? Brian Levitt joins us here. He's a professional. He does this stuff for a living. Global market strategist for Invesco. Dude's on the road all the time, but we got him in our studio here today, so that's a good thing. Brian, what are you telling your clients these days about kind of where to be in this market?
It's interesting because the leading indicators of the economy are pointing lower. So they're pointing towards below trend weaker growth, which is when, of course, you then need to follow through on the policy side. So in the short term, you're getting more of a signal to be a little bit more defensive, a little bit more higher quality in your investments. And you've seen that in government bonds, not necessarily as much in stocks, given how overvalued some of the biggest high quality names were. But we are getting more of a defensive signal in here. What you hope for and what you're alluding to is as the Fed starts to normalize rates, do you get the proverbial soft landing and markets doing well over the next couple of years? And I'm in that camp. I think the markets will do well over the next years, intermediate term, given that we're past peak inflation and peak tightening.
So there was a great chart on Bloomberg that showed, if you go back to the top that we saw, I think in June, what's led since then has been anything but tech.
Yeah.
And which is quite interesting. And I'm just wondering which area of anything but tech can continue to lead.
Yeah, it's nice to see the equal weight. It's nice to see some broadening out in these markets. Look, if you're defensive in the short term like we are, then the type of sectors that tend to do well are things that are a bit more rate sensitive, like real estate, healthcare has done well, staples. When you start to think about the recovery, so I want to be clear here, our tactical indicator says more defensive. We would expect as you move into 2025 to see more of a recovery feel, meaning that growth is below trend but starting to pick up on the back of easing. That's when you want to be more exposed to cyclical sectors. That's when you want to be more exposed to, international markets, full risk on in the portfolios. I think we're going to get there. Right now, though, again, our tactical indicator is suggesting to be a little bit cautious here.
Well, when you say cautious, how then do you manage that? Like, what's the best kind of allocation?
Well, we would increase duration in the portfolio, which has certainly worked, right? So we've seen rates come down pretty significantly, higher quality bonds, and within equities, not that we're saying you need to eliminate your equity exposure, not at all. It's just where in equities do you position? And typically in a growth slowdown, you will see more defensive sectors outperform. You'll see higher quality, low volatility tends to win. It's more recovery phase, again, as we either get this soft landing or come out of an economic downturn where you tend to see more cyclical parts of the market outperform.
How do you feel about valuation broadly defined here? Do I have to pull out those Mag 7 and then adjust the market for valuation? How do you think about it?
The first thing I always say about valuations is they're not timing tools. And I think too many people get caught up thinking that markets can't do well because stocks are trading above average. So that would be point one. I don't view it as a timing tool. Point two, you're right. The S&P 500 in aggregate is trading above valuations, but the average stock is not all that excessive, and the valuations on the equal weight compared to its average is about fair. So I wouldn't view this as an environment where stocks are particularly expensive. And I'm also looking at it from an environment where rates are going to come down. And as rates come down, that should be supportive of valuations.
What do you do with what do you think will be done with all the money in money market funds? As in, like, first cut, zoom, they come out and go to other things? Or is it like once we get the cycle going, is there a threshold rate where that money finally starts to move?
Some of that money came out of bank deposits.
Yeah,
so it was money that
I was one of them.
Right, yeah. So if you're getting zero in the big money center banks, going to money markets at 5.25 makes sense. Even at 3, right. So does all of that find its way into the equity market or the high yield bond market? Probably not. Some of that is still going to be considered a cash-like instrument. But I would advise investors to think about quickly, and we've been saying it for a while, how you're going to take advantage of the yields that presented themselves. You know as well as I do, in 2019, people were begging for 4%. They used to ask me, how do I get 4%? I would say you either have to put it all in high yield or you have to lend money to the Russian government. So that was a difficult conversation. Today you could get close to 4% in, or you can get 4% in municipal bonds, in high quality corporate bonds. So I would advise investors to take advantage of it. Unfortunately, I think a lot of that money's still sitting there with the reinvestment risk that it's had for a while.
Small and mid cap, what do you think about looking there for value?
It's interesting. So, I mean, small cap has become 4% of total market cap. I think it used to be 10. So over the next number of years, small cap should see good performance as that reverts to some type of mean. What's interesting is in a growth slowdown, which we're forecasting, small cap tends to not do well. Small cap has performed well on the expectation of lower rates and, lower rates across the yield curve. So I'd be a little bit cautious on small cap while we're maintaining a defensive posture. But again, the recovery phase of this should benefit small, and I would think over the next few years benefit small again, just because of how undervalued it is to the mega cap names.
This Saturday, USC comes into the big house. How you feeling about your Wolverines this year?
Well, it's a little bit mixed. I think we're playing a little bit with house money after winning a national championship last year. New coach, new quarterback, a nice win against Arkansas, but the Texas overhang is still there. So we'll see. I don't know if my confidence is anywhere near what it was in the 2023 season.
Is USC, are they in the Big Ten now?
They are in the Big Ten.
Geez, that's just ridiculous.
It's hard to follow, right?
It's silly. Okay. All right. Well, I got Stanford coming in to play my Dukies at some point this year, so we'll see how that goes. And you're going to send the field hockey team from Piscataway, New Jersey, Rutgers, all the way to Los Angeles to play field hockey?
It feels like a long
Is that what
trip.
we're doing?
Especially
Brian
with
Levitt?
those sticks. It's hard,
Exactly.
I would think, to do
Brian
that.
Levitt, Global Market Strategist for Invesco, joining us here in our studio today, giving us his thoughts.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, within the markets, there was some really interesting commodity positioning, and I don't just say that because I'm a commodities nerd, but oil has seen such a strong re-rating, and it's so interesting because hedge funds are net short on oil for the first time since the data started being collected back in 2011. Oil's up by about 2-3% today. Joining us now is Mike McGlone. He is Bloomberg Intelligence Senior Commodity Strategist from London. This is a new background.
I can't believe they took his passport. You got into London. Amazing. After all the lists I put him on?
Way overdue to visit.
Good.
Well, it's good to see you. Let's just start with oil for a second. I mean, at this point, are we so short sort of the market that there's no way we're not going to get some kind of snapback?
I think that's a good response, Alex. The first way you look at it as a commodity trader, yes, it's really Brent that's short 12,000 contracts. It's never been short, and that's most ever, as you mentioned, since 2011. Like WTI is still somewhat long, but I think Brent's more reflective of what everybody sees what's going on with China, excess supply, and the fact that you need OPEC to keep OPEC oil off the market, or market's going to do what it usually does and get cheap, and it's just kind of tilting towards there. But to me, this is indicative of overall commodities, a bearish sentiment. And I think it has good reason. Just look at that 10-year note yield in China, 2.07%. It's the lowest ever. I mean, compare that to U.S. at 3.66 at the moment. To me, it's just, you could say a bounce from here, but I think the responsive traders are going to be looking for rallies to sell, which I put for good resistance WTI around 75, and I'm still expecting to do what it has been since 2008, get really cheap, which probably means around $40 a barrel.
One of my favorite indexes is BCom. Are you guys celebrating a BCom kind of anniversary or something coming up?
Exactly. Well, I'm glad you mentioned that. So I'm in London. We have the BCom Index Advisory Committee. I think I've been going to these for about 20 years, particularly when the BCom was at S&P and I managed it there. But now it's a better place at Bloomberg. But it's a bit of an anniversary. It's also where everybody gets together and we talk about how to properly manage and rebalance the index.
So how do you do that?
Yeah.
Well, it's also the methodology, but you have to take advice and counsel from the people who are involved in actually tracking it. I used to actually do that math, but it's very systematic. It's mostly based on the BCom's based on total volume, and it's broken up between the three sectors: energy, metals, and agriculture. It keeps them somewhat equal rather than having too much of a weight in energy.
All right, I'm going to go right to one of my favorite commodities, corn. It's off 13% year to date.
I can't
People
eat
aren't
corn.
eating corn.
It's
I
like
love
doing
corn.
You
weird
can't eat
things to
corn?
my-
You don't
No,
eat corn?
I love corn.
Jersey
It's
Shore?
just, you know,
No, he just
Jersey,
can't.
Jersey corn?
I can see
weird
that.
things
And like
to me.
soy can be hard to digest, like
please.
some of those guys. Okay.
All right.
I won't go
You
into
do.
detail.
All right, give us a smart call on corn here, Mike.
You do, but you don't know it. Corn is the most significant global agricultural commodity in terms of dollar value metric production. That's part of the methodology we'll be talking about on Wednesday. But it's in everything. And actually, it's animal feed, corn syrup, and everything. But the key thing is corn got way too expensive in 2022. Now it's getting towards really cheap. It got down below 4. The last two contracts closed around 380 or so, which is right around U.S. cost of production. And to me, the significance of corn is that's what all commodities are doing. They have to get below that cost of production, have to shut down those excesses of supply and reinvigorate that demand. And corn's just the lead. It's the most elastic of the commodities because you can bring on that supply in about a year. So to me, that's part of the reason I'm still bearish crude oil. And actually, one of those indicators in the middle space was natural gas. Why? Because natural gas is a top form of fertilizer for corn.
Okay, see, it all comes back. What about coffee? So on the flip side, corn's below $4 a barrel, a bushel at one point. Coffee is just crushing to the upside. I mean, Robusta or Arabica, talk to us about it.
Yeah, and we don't track it too much. The thing is, significance of coffee and cocoa is they're both grown right around the equator, and climate change, I think it's directly affecting those commodities, despite things like corn and soybeans and wheat, which are more born in the northern country, potentially in Brazil and U.S., where the weather's still been quite productive for production.
All right, let's go over to the metals here. Copper, up about 10% year to date. What's the call here on copper?
I think the risk is copper goes down, partly because just look at bond yield. So one good way to look at copper, the price of copper on the screen right now is about $4.30 a pound. If you overlay the pounds of copper with the percentage yield of the 10-year note, that's usually where they've been trading almost the last 10 years. So I pointed out China's 10-year notes at 2.07%, U.S. is 3.65. I think copper is just on the cusp of breaking lower with most other commodities. Last few weeks it's been crude oil just kind of catching up to the grains. And the key thing for copper to stay resilient is U.S. U.S. stock market has to stay strong. But yet we've priced in so much buy the rumor into the Fed ease. To me, the risk is sell the fact. And copper, you have to mention in the same sentence as China. China's in a pretty severe deflationary trajectory at the moment.
Yeah, I definitely was reading Citi put out like a quarterly note on commodity outlook, and then for copper, like longer term, they still see that structural shift, energy transition, and all that demand. But then in the near term, you just can't escape sort of the downdraft in China there, and then how you kind of manage that. But there's still broad growth, and like the trough maybe being like 8,000 to 9,000 versus 4,000 to 5,000, which it might have been in different cycles. All right, what else you got? What else are you looking at?
Well, the number one commodity that's going up on the planet, was more the store value, is gold. I got to stick with something in my space that's going up. On a year-to-date. Yeah, well, there you go. On a year-to-date basis, gold's up about 34%. Compare that to the total return of the S&P 500 is 28%. 3 years now, the rock is beating stocks. The risk is it continues. I think it will. And the thing is, you have to just look at the macro. One thing in managed money net positions, we pointed out earlier, hedge funds are quite long, but ETFs have been in significant outflows. They're really just starting to turn to inflows. So I think that's going to continue. You should get some bucking of that bull. But overall, to me, that's a market that's heading towards $3,000 an ounce, and it's probably backing up. Maybe you'll see good support around 2,400.
All right, Mike, thanks so much for joining us. Hey, Mike, you go across the street from the Bloomberg headquarters, Ye Old Watling Pub. Mention my name. They'll take care of you over there, okay?
Done.
Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. It's a great pub.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now in studio is Uma Moriarity, Senior Investment Strategist and Global ESG Lead over at CenterSquare, and she joins us for her outlook on the market. Uma, the moment is here. We're like 24 hours away from that first rate cut, whether it's 25 or 50. How does that impact the space you cover?
Yeah, I think this is probably going to be the most widely anticipated rate cut of all time, definitely in the space that we cover here at CenterSquare in real estate. Across the REIT market, I think this has been a big catalyst that we've been waiting for. If you look at just where the REITs are trading compared to broader equities in terms of multiples, we're trading a lot cheaper than we typically do compared to historical averages. And I think this has been the catalyst that we've been waiting for in the REIT market to really see some good momentum. We've been seeing it so far this year. REITs have had a bit of a bid, and I think that's going to really continue as we see further rate cuts on the horizon from the Fed.
So where in the REIT business do you guys prefer to play? Commercial, residential, where within? I know there's a lot of subsectors even within those two broad categories. Where do you guys typically like to play?
You know, what we're really focused on right now is looking at not only the things that are going to be benefiting from rate cuts, but also things that are going to be winners in a secular way, right? So there are a lot of different opportunities within the REIT market to find secular growth. One of those areas is in healthcare, seniors housing, for example. You have aging demographics that are really going to create an insane amount of demand, I think, for the senior housing space. And couple that with the fact that you see...
Wait, you just pointed at JT.
What are you talking about?
Wow. He just redid his bathroom. He doesn't need senior living space. Anyway, go ahead.
Anyway.
Just ignore him.
But yeah, so we've got some great demographic tailwinds here for the senior housing space. And you kind of couple that with a few other things, right? So during COVID, we saw margins really being impacted because of labor costs in the senior housing space. So you're seeing a recovery from that. Plus, you're seeing that space being institutionalized, right? And so there is a massive opportunity from an acquisition perspective there as well. So all of those things playing into senior housing, data centers, I mean, another great play within the commercial real estate sector. So those are the types of things that we're looking at. We're not only benefiting from the rate cut environment, but also really benefiting from secular tailwinds.
So based on that, okay, but the senior housing, the data center, et cetera, I hear that a lot from REIT people. So is the market really crowded?
There's definitely a little bit of crowding in some of those areas. The other thing we were just talking about here, right? A couple tactical opportunities within the office sector, I think, could be really interesting here for investors. I think within the broader commercial real estate world, office is a part of the real estate world that is really troubled, especially on the private market side. Whereas the REITs have top tier assets. When you think about the best assets here in New York City, they're really owned by the REITs. The REITs have great balance sheets, low leverage, access to capital from the unsecured bond market, from the equity market that you just don't have across the private market. So I think in some areas, the office market within the REIT space is going to benefit here and be a capital solution for what's happening on the private market side.
Because we really haven't seen that much activity in the office space to really get a sense of where value is, have we? We just haven't had a lot of transactions to say, hey, is the discount 50%, 30%, 70%? We really don't know that. Are the REITs going to be the ones that set those levels, do you think?
I think they could be. And I think the reason you really haven't seen that is because there's been such a bifurcation between the haves and have-nots in the office market, right? One Vanderbilt here in New York City leasing up at really, really toppy rental rates. Whereas if you try to go lease a commodity office space, it's probably sitting vacant. You're going to continue to lose vacancy. So I think there's a big differentiation between quality. And so you'll see the REITs and in general, the market really open up as we see a bit more stability on the rate side as we try to figure out what happens from the debt perspective here as well.
Is it like one rate cut that makes a difference, or is it just the cycle that we're starting, or is it how many cuts we're expecting is going to be a catalyst for the market?
I think just the fact that we're getting rate cuts and we're kind of out of this potential
like you're
rate
off the
hike
top,
situation.
basically.
Right, exactly. And you get a little bit more clarity in terms of where things are going. So I think this week when we get some economic projections from the Fed, will be important to see where that dot plot sits at the end of this year, at the end of next year, to see where they're going from a rate perspective. That being said, a lot of real estate also really prices off of the long end of the yield curve, right? And we've seen that kind of a little bit range bound around the 3.5% to 4.5% range. And so you'll see a bit more price discovery as we kind of accept that that's where long rates end up staying versus where we had been seeing those rates kind of post GFC through COVID at significantly lower levels.
All right, let's say I'm a real estate investor. I've got some equity behind me. I'd strike a deal to buy one of these office towers on 3rd Avenue, 46th Street at maybe 50 cents on the dollar. Can I go to a bank and get money to do this? Will they lend me money for that type of transaction?
Currently, I think the banks are really relationship driven. It's based on whether you have an existing relationship
So for
with
you,
them.
TBD.
TBD.
No, I'm kidding. They probably definitely lend to Paul.
But I think a lot of where the debt capital is coming from currently within the marketplace is a lot of alternative providers of debt, private lenders. Banks in general are still a little bit overexposed in the real estate space, and so you're going to continue to see banks needing to pull down their real estate exposure. Office definitely is not one of their top priorities in terms of increasing exposure at this point, right? So it's not really clear in terms of whether bank lending might exist for something like that without a relationship. But I think the private markets are starting to get a little bit more interested in opportunities within the office space at the right price.
All right, Uma, thanks a lot. We really appreciate it. Thanks for coming in. Uma Moriarity joining us, Senior Investment Strategist at Global ESG Lead at CenterSquare, joining us on the REIT market. Thank you very much.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Okay, that is Monday, and usually around this time, we check in with our folks at Bloomberg BNEF. They cover all the data, they have all the analysis on everything from transport, industry, commodities, power, buildings, ag sectors, anything that you need in the energy transition, they do. So joining us now for more is Bo Qin, Lead U.S. Carbon Analyst at Bloomberg BNEF, and she joins us now in the Interactive Broker Studio in Midtown Manhattan. Okay, so first of all, what is the carbon market in the U.S. right now? What does that mean? Let's dumb this down.
Yeah, carbon markets is one of the most exciting markets right now because it quantifies energy transition, which could be quite fluffy. And having a carbon price, it basically shows you where are the opportunities and risks for industries, lawmakers, as well as investors.
So when we say carbon market, like it means the price of, I'm like a cement maker and I emit 1 ton of carbon, what that price of that carbon is.
Yeah, exactly.
Okay.
So there are 2 kinds of carbon markets. So there's compliance carbon markets and voluntary carbon markets. You probably heard quite a lot of news about forestry and carbon offsets this year. But there's also that compliance carbon market, particularly in the US, that has been a rising star this year. The compliance carbon market, so what it is, it's basically regulators setting a scope and a target for decarbonization. And this market decides a price, and it decides who are the cheapest to abate and what is we call it a merit order, but what is the order in which the polluters would reduce their emissions, and the cheapest would reduce first, and the most expensive will first buy the allowances and later reduce their emissions.
So California, I don't know that much about this market, but I know California is kind of out in front, and number two, I know it's a kind of a big state.
Yeah.
So what's happening in the price of carbon in California?
Yeah, California has been really in the news right now because of the reforms that are going on in California carbon market. So California carbon market is just one of the pieces that one of the tools that California uses to direct their energy transition. And this whole story really started from the scoping plan of 2022, where the new target of net zero by 2045 has been set, and the California carbon market has been selected to guide this transition amidst other policy tools.
So yeah, go ahead. Sorry.
Okay, yeah. So we have been watching US Open here, so it's kind of been watching a long set of a tennis game where we had been seeing how this target been translated into a cap trajectory. So what cap means for compliance market is basically supply. Compliance carbon market is very commodity based, so you would look at supply, which is the allowances, and then demand, which is emissions. And the supply has been in this reform process that has been given a lot of different guidances, which have been kind of exciting the market, but also confusing the market. So looking at just the prices, the price have gone up since from $19 per metric ton in 2021 and shooting up to this year in February, hitting a $44 per metric ton. So investing in this asset has been a massive rally. However, the prices have come down now, so we're now around 35.6.
Is it better for the energy transition to have higher prices or lower prices? As in, like, if it's higher, companies are going to be like, I don't want to pay that, I'm going to go offset my emissions, or lower, meaning that it can be a more robust market?
Yeah, exactly. That's a good question. We typically want a gradually increasing price, so it shows an incentive for industrials and compliance entities, or just entities in general, to decarbonize. But we don't want big price volatility because that could make it difficult to direct strategy and make those big investments to clean tech. And this is why also we do think, like, in US it's important to make sure that we have big enough carbon markets. So we mentioned California. California is the biggest carbon market right now, and it's linked with Quebec in Canada. And there is actually another carbon market that started last year, which was very exciting for us. It was Washington State, and it hit a carbon price of $73 per metric ton in the futures market, which was very exciting for us. This is the record price ever in US, and it's right next to California, which there has been also bills proposed to link these carbon markets together, and we do see that this would be great for both of these carbon markets. One is because it would reduce that price volatility that we mentioned, but also bring the carbon leakage down as well as...
Bo, we got to leave it there. We're up against a break. But Bo Qin, thank you, Bloomberg BNEF Carbon Analyst, joining us there.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.